Last week, we learned about how robo-advisors work and help us achieve our investment barbell strategy. Today, we'll dig into some of the essential aspects for choosing financial advisors. Then, we'll discuss several robo-advisors and their selection criteria. Also, my book, Making Choices, Making Money, provides more context and smartphone tools for deciding on the best robo-advisor. But first, my name is Jeff Hulett. I'm a decision confidence builder. I'm a behavioral economist and have been in banking and financial services most of my career. I'm also a faculty member at James Madison University, and I lead Personal Finance Reimagined, a decision-making and financial education platform. First, as a reminder from our last vidcast, here are the 3 big things a good investment advisor does. They are: 1. Develop set it and forget it investment strategies. 2. Auto rebalance portfolios. And 3. Optimize your tax liability. Now, there are certainly other services based on the situation, but this list encompasses the foundational services. Now, let's discuss 3 different kinds of advisors and why incentives matter for how they help. First, check out the wealth distribution graph at the bottom of the screen. This is from the Federal Reserve. This represents a well-known challenge that a small percentage of the wealthiest Americans have a very large percentage of the wealth. About 2% of Americans have greater than $1 million on average wealth, At 5% of Americans, the average moves up to $5 million. And then at 1%, the average for that group is over $12 million. At the other end, the bottom 50% as a group only hold 2.5% of total U.S. wealth. The challenge is that over time, this wealth inequality has gotten worse, not better. At Personal Finance Reimagined, our goal is to help people fight against that trend and achieve more wealth. There are 3 different kinds of advisors depending on where you fall on this wealth distribution. At the far right, human wealth advisors are focused on the already wealthy. You may ask, why don't they help the people who really need it, like those not wealthy yet? They seem like a group that really needs financial advice. The answer is, in a word, incentives. Human wealth managers' revenue is based on a percentage of their clients' wealth. So the lower the wealth, the lower they get paid. But wealth managers have to pay rent and keep the lights on. They have SEC compliance forms to fill out, salaries to be paid, and certifications to maintain. It all costs money. Wealth managers cannot afford to help anyone else other than those already wealthy. They are simply playing by the rules of their industry. Now, let's go all the way to the left side. About 5% of people have negative wealth. These are often people that have gotten themselves into debt trouble. They need help getting out. There are nonprofits providing assistance. Well, you may ask, why don't these nonprofits help people before they get into debt trouble? Well, the answer is, and you guessed it, incentives. A large funding source for debt repair nonprofits are the very banks that lent the money getting their clients in debt trouble in the first place. Now, helping debt-troubled people to structure their obligations helps those banks that are funding the nonprofits get paid. But the banks do not want to help with their already paying customers. This leaves a massive middle. Look at that. About 90% of all Americans are either not wealthy enough to get help or are not in enough debt trouble to get help. This massive space is getting filled by robo-advisors. Now, let's discuss a brief robo-advisor history. Now, it is brief because robos have not been around very long, but the history helps tee up the next discussion about which robo-advisor to use. The first movers in this space were monoline fintech firms, notably Wealthfront and Betterment. Then, early on, the big investment banks considered the monoline robos as a small annoyance. The robos did not yet have the market traction or scale to get the attention of their larger competitors. Over time, the robos flipped that script and got market traction. The big investment banks came to see them as an upstart competitor. Now, fast forward to today, the big investment banks have crossed the if you can't beat them, join them chasm and have rushed in to stand up or purchase their own robos. The big investment banks have some natural advantages the monoline robos do not. For example, capital. The big investment banks have massive capital stores to invest in robo-advising, plus the big investment banks are diversified. Many large investment banks have commercial banking subsidiaries or affiliates. When comparing the robos, there are two big costs to consider. First, AUM fee. The AUM fee is the investment industry jargon for assets under management. Most robo-advisors charge a fee as a percentage of the assets they manage. Currently, the robo-advisor market is around 0.25% or 25 basis points annually. By the way, basis points are just another way of saying a percentage. So when I say 0.25% or 25 basis points, they're basically equivalent. However, the best part about the robo is because of their low cost of service and automations, they have very low minimums, sometimes less than $100 to get started. As an example, both Wealthfront and Betterment, as of today, have an AUM fee of 25 basis points. However, Schwab, on the other hand, the big investment bank, does not charge any stated AUM fee for their robo. We'll come back to this later. The other fee to consider is the fee loads of the underlying funds the robo-advisor manages. Many robo-advisors use funds like ETFs, and they should have very low loads, usually less than 10 basis points. As we'll see, this is very important to check. So, now let's circle back to the AUM fee, with Schwab not charging that fee. Your initial response may be, yay, great news. Why would you use less known robo-advisors when a better known brand like Schwab does the same thing and for no cost? Upon reflection, you may be skeptical, as I was. You may have asked, if Schwab does not charge anything, how do they stay in business? Is there another way they are making money? Great question. Stay tuned. We'll show you how Schwab's fees are determined and that their costs are actually higher than most. Next are the typical criteria for comparing robo-advisors. To the right are several robo-advisors I use today or have used in the past. Let's discuss criteria. 1. Fees are the two These are the two fee categories we've already discussed, but you should consider if they have other fees. We will discuss next how Schwab charges a hard-to-see fee. Investment strategy. All robos should provide standard strategies based on your risk profile. For example, a high-risk tolerant person would have a higher percentage of their portfolio in high-growth equity funds and a lower percentage in highly rated bond funds. Some robos have some specialty strategies, like environmentally sensitive strategies and others. Then 3, diversification. All robos should be highly diversified by virtue of using ETFs and regular rebalancing. You'll want to confirm this. 4, customization. A more sophisticated investor may wish for more ability to customize the strategies to a specific need. Most people, like the vast majority of most people, do not need customization, but you never know, you may. And then 5, user experience. This is a combination of the smartphone tools and website ease of use, plus the available education content. Many robos have excellent articles, videos, blogs, etc. to help you learn. When we evaluate these criteria in my college class, we use our decision app called Definitive Choice. Finally, finding this information to compare this criteria is as easy as asking a GPT the correct question. Now, we need to evaluate the criteria. Robo-advisors may change. So the best thing I can do is help you easily find this information. It's all about asking ChatGPT or other GPTs the best question. The GPT is like your research assistant. To be fair, like many junior assistants, they do not always get the answer exactly correct, but they will get you much of the information you will need to then confirm it with a quick review of the websites. This is the question I ask Bing's Copilot GPT. Please provide a table that compares major robo-advisors by at least 5 different criteria. The criteria may include both quantitative and qualitative comparisons. The criteria should also compare fees. Please include the following robo-advisors: Acorns, Wealthfront, Betterment, Vanguard, Fidelity, SoFi, and Schwab. So there you have it, the good GPT question. I'll drop that question in the video comments. Then all you'll need to do is copy and paste it into your favorite GPT provider. This information is helpful when weighing the criteria by using our decision app called Definitive Choice. You get that app with my book, Making Choices, Making Money. If you are looking to get started, either Wealthfront or Betterment are a great choice. They both have low minimums, low AUM fees, use ETFs with low load fees, and have competitive performance. They both have auto transfer to automate investment funding. This is mostly a DIY experience, but that is to be expected. Finally, I want to leave you with a few cautionary suggestions. Be on the lookout for conflict of interest and economic discrimination. Conflict of interest occurs when the interests of one bank's internal organization conflicts with another of the same bank's internal organization. For example, Vanguard and Fidelity both manage and sell mutual funds and ETFs. The interests of the fund selling group may conflict with the interests of the robo-advising group. I'm not saying a conflict has occurred. I want to be clear about that. I have no idea actually. But within these organizations, but I am saying it is more possible because these organizations appear to have both motive and opportunity. Economic discrimination is how an organization's target pricing to individual customers based on their demand sensitivity. Some customers are more price sensitive than others. A signal for economic discrimination is when pricing is well below their competition. This just means they are making up that pricing somewhere else. Unfortunately, it is not always easy to understand how they are making it up. Next, let's discuss how Schwab is using cash accounts as a way to make their pricing difficult to compare. Based on their website example, Schwab sweeps about 8% of client AUM into low interest bearing bank accounts. Let's say you have a Schwab robo-advisor account with a $10,000 investment balance. That means 800 of it, or 8%, would get swept into a low or no interest bearing cash account. Schwab uses very cheap FDIC insured money to make loans and other investments through its bank for itself. Schwab Bank is an affiliate of the Schwab organization providing the robo-advisor. Let's do some quick math. If the long-term average annual yield on the investment strategy is 11.5%, then multiplying it by that 8% cash holding requirement means the effective AUM is 92 basis points. This is well above the standard 25 basis points for the industry. Via the investment barbell strategy we discussed earlier, you would manage cash in quadrant 1. By doing this, you provide for your liquidity needs by using high yield savings accounts or some other cash account. The reason we have cash is for liquidity. That's important. You would never use a robo-advisor for liquidity because you can't withdraw only the cash portion. This is really important. While maintaining cash is essential, it needs to be in a liquid account outside a robo-advisor. This is an example where both conflict of interest and economic discrimination rear their ugly heads. For me, I would rather not have to worry about it. As such, I am more likely to invest with the robo-monolines that do not have these potential organizational conflicts. I do want to disclose, not long ago, Schwab did agree to a settlement related to this case study with the U.S. Securities and Exchange Commission. Robo-advisors have some amazing benefits. They are truly filling a massive wealth gap for most Americans. They have lower costs and lower minimums. We showed you how to evaluate robo-advisors and snuck in a little AI technology for your benefit. We also cautioned you about potential conflicts leading to higher fees. Next week, we'll be talking with robo-advisor experts Barbara Friedberg and Josh Mountain. They both have diverse and interesting robo-advisor and investing perspectives. But until then, you've got this.